First of all, the original Basel I was all about capital. Okay, what is bank capital? It's the bank's own funds, shareholders' funds, if you like, and long-dated debt holders' funds. Okay, so equity, ordinary shares, retained earnings, reserves of the institution, and then additional types of capital, additional tier 1, for example, long undated subordinated debt, and then dated subordinated debt. Subordinated, i.e. it's lower ranking in the profile. You can see the ranking there in the chart. So that is bank capital. And capital is something that every institution has, the firm's own funds. Banks, compared to other industries, though, are much more geared or levered. The balance sheet is much more leveraged, if I can use that word next to the word balance sheet, because, of course, there is much more debt funding than own funding supporting the business operations. And so, like any firm, a bank would have had its share of capital on the balance sheet. But today, and since 1992, that minimum amount is required under law. So how much capital one has is now directed by the regulatory authority. It's no longer up to you. And if you think about it, 1992 is not that far away, not in the history of banking. You know, original banks from the 15th and 16th century onwards, so banking itself around for 500 years, but it's only relatively recently that a minimum level of own funds for the balance sheet of the bank has been stipulated under national law. Banks should maintain sufficient capital to avoid solvency problems. Absolutely. To be resilient against failure, banks need a large enough buffer of capital. This, of course, capital is the bank's own funds, so if the bank is losing money, it is losing its own money to support these losses or to cover these losses, and so therefore it needs sufficient of its own money to cover losses. The principal area of losses is, of course, credit risk. You lend money to your customers, the customer defaults, doesn't repay, you lost all that money that you've lent the customer. And so your capital base needs to support that. Hence, you need to be solvent. Now, all corporations need sufficient capital to be solvent. If you go back to the original Merton model from 1974, some of you will be familiar with that, we define insolvency or bankruptcy very simply. We define it as assets minus liabilities equals a number less than 0. Once your liabilities exceed your assets, you are insolvent and therefore technically bankrupt and going into insolvency administration. So a bank needs sufficient capital to avoid this insolvency issue arising, like indeed any institution would need if it was to continue as a going concern. Key characteristics of capital, it must be able to absorb losses, absolutely. It should be perpetual, in other words, you don't have to repay it. Now that said, we've just introduced a type of capital that has a repayment date, but it needs to be reasonably long-term enough to be considered capital, and also it can only form a portion of your capital base. A minimum amount of every bank's capital needs to be this perpetual, undated capital. Okay? Distributions, coupons, dividends are not obligatory. So for what's called the tier 1 capital, I'm going to show you that in a second, you can always hold off paying a coupon. You're not obliged to pay interest, or in other words, a dividend on that capital base. In return for having this type of exposure to the institution, the investors who are holding this capital, whether it's equity or long-dated debt, will be requiring a higher rate of return because they're taking a higher rate of risk. That's not unique to banks. If you're holding the shares of any institution, the equity of any institution, you will be requiring a higher return over time for holding that compared to holding the lower risk liabilities of the same institution.